question answers if we've not answered all the questions. Is that okay with everyone? Is that okay? Okay, good, great. Thank you. So this, Harish, is the topmost question in our minds, right? So we don't know which way markets are going to go. They've opened up the economy now, and will COVID cases go up and will markets go down, or will markets open up and because the economy is opening up, will the markets go up? We don't know whether we should stay or we should exit or what to do, right? And you've always been telling me that you can have the cake and eat it too. It does come at a little cost, but we'd like to understand what this cost is so that we can make the right decisions. Right. So help me understand how this works and what is your philosophy behind saying that you can have the cake and eat it.
Sure. So yeah, it's kind of weird to look at a screen and you're kind of just moving and some glass I can see. So it's interesting. This is a very interesting one. And when you started off by saying about COVID cases in market, I feared that you're going to ask me what will happen to the market now. And I have no idea, to be honest. But yes, over the last 17 years or so, I have realized that anybody who has an active portfolio in the market for long term should be able to use derivatives in some way so that you can either hedge it at some cost, of course, or optimize your portfolio in multiple ways. And there are ways you can actually do that. Unfortunately, it's not known to everybody. So that is the reason why I think a lot of people are not aware of how actually can be done. So as you said, the theme of this session is, can you have the cake and eat it too, kind of a thing. I think it is, yeah, possible. And maybe over the next 45 minutes or so, we'll be discussing that as well, Purna.
Yes, amazing. Okay, so you were talking to me about using derivatives, right? So what
Right.
happens if somebody's already invested, right? They're already invested in the market. They've seen those losses. They've seen their portfolios down 20, 30%. And they're like saying, I can't take this anymore, yeah. This is the limit, I mean, it's paining me enough. I don't want markets. If markets go down further, I can't handle it. Now I call my financial advisor and they say, no, the upside is coming, don't exit, right? Just tell me, can I somehow protect myself from, if markets go down, can I protect myself? What can I do?
So are you referring to an investor who's already invested in the markets at this point?
Yes, somebody who's already invested, they've been through this, during March, and they've seen their portfolios down. Markets are slowly showing recovery. It's not yet come to even purchase price, but
Yeah.
I don't. I more than anything else, I don't want further fall and more pain.
Sure. So what I can do is I have taken some data from the market as of yesterday. I would like to show that to the participants here. Can you see my screen, Bhuvna?
Yeah, I can.
So for all the discussion that we will do today, the assumption that we are going to make is everything is live as we speak. So I am not doing any back testing. I'm not showing any data which is academic or hypothetical. So what I've done is taken all the data from the actual markets as we speak. So yesterday Nifty closed at 10142. That's the level of Nifty for yesterday. So what I've done is the first question that you asked me is about hedging. So if you already are sitting on a portfolio and as you said, you don't want any downside risk further, you can simply, the easiest thing you can do is buy insurance. Just like you buy a vehicle insurance or a term insurance policy, you can actually go out there and purchase what is called as put options. So I am not going stock specific in this particular session, but the same thing you can do for a specific stock. I am looking at what is called as NIFTY put options. Okay. So what I've done is I have taken the premiums as of yesterday, and because it is like an insurance contract, you have to pay a premium to purchase what is called as put option. So when you purchase a put option, all the downside from wherever you buy the protection, that downside will be protected. You will not have loss below that certain level. For example, market today is 10,142. So I have taken a 10,000 strike price put. What it essentially means is if you don't want any downside below 10,000 levels, you can simply pay this premium of 600 rupees. This is the approximate premium as on yesterday. And this option is still December. Sorry?
600 rupees for every 10,000. You saying
no, it is 600 rupees per Nifty. So essentially what will happen is that you are going to pay per lot of 75 Nifty. So your
Okay.
actual outflow will not be 600, your actual outflow will be 75 times 600. But 10,000 is per Nifty, 600 is per Nifty. That way it is comparable if you want to compare. So that percentage from the current market level is 5.92%. So roughly 6%. And this is for December. Let me be clear. So what I'm trying to say is, if you
Uh,
pay 600 rupees,
uh,
anything below 10,000 market level can be hedged. You will not have any loss below 10,000. And the cost of doing this, the premium you are ending up paying is 6%. And this is not per annum. This is 6% of your portfolio till December, which is roughly, I think, about 6.5, 7 months that we are talking about.
so
So,
if I have, let's say, about a crore of rupees in invested,
yeah,
and if I pay 6 lakh rupees,
yeah,
if the portfolio drops to 70 lakh rupees also, let's say, for example, I will be protected for the 1 crore rupees.
absolutely. Which means what is happening is that below the 10,000 level market. So mind you, currently market is 10,142. So
Okay.
there is a 142 rupees loss you will have to incur, obviously. But
Yeah.
anything below 10,000 you'll be protected. And what is the cost of that protection, which is non-recoverable? It is roughly 6% for a 10,000 level protection.
So what you're saying is my maximum loss that I will incur is this 6%. If markets fall also,
Correct.
six, if I paid out of my pockets this 6%, that's all is my loss.
Correct. The other way of looking at the same thing is, now after you do this, let's
Yes.
assume market does not fall, market goes up by, let's say, 8% in the next 6 or 7 months. Then
Okay.
do remember that your portfolio will go up by 8%, but this 6% loss you'll have to incur. So essentially your net profit is also going to fall by 6%.
Okay. Yeah. Obviously. Yeah. Okay. So this is an expense that I've already incurred,
Yeah,
and yeah. So I have to write it off. So 6% cost for peace of mind. Does that make sense?
absolutely. So you can sleep peacefully, whatever happens to COVID, whatever happens to US China issues, whatever happens to China India issues, you
Okay.
can be rest assured that below 10,000 levels your portfolio is secured. And what is the cost you're paying? You're paying a fixed cost of 6%. Now, suppose you're okay till loss of 9,500 levels. So you're
Okay.
saying that till 9,500 I'm okay because maybe I have that much risk appetite in my portfolio. Then you can buy a protection from below 9,500. It will come to you at a cheaper premium. It will be only 4.3%, and so
Okay.
on and so forth. So as you go, what is called as out of the money, if I may use a jargon, the premium cost will keep on falling that you will pay.
Okay. Okay. So today 10,000 is in the money, 9,500 is out of the money.
Even 10,000 is out of the money because Nifty is at 10,142. So you're near the money. You're 142 away from the market. So none of these strikes are in the money.
Okay. But already markets have fallen so much, right? So, expecting another 20%, of course, well, I mean, nobody knows for sure. But is there any way that this 6% can be reduced or?
Yeah, so we can add different levels of strategies or combinations where you may want to protect your downside and also try to not pay 6%. Uh, may I request all of you to be on mute? There's a little bit of disturbance that I'm seeing. So, yeah, so what I'm saying is you can try and recover a part of the 6%. I will show you how
बोलो
that
बोलो
can be done.
ये निकाल रहा हूँ यहाँ से बोलो
There's something called so I'm not able to even unmute them.
Just give me one
नहीं अब
second,
नहीं
please.
होता कम होता है मतलब
Sorry, I think, is it better now, Bhuvna? Yeah. So what you can do is, if you want to be a little more, uh, if I would use the word creative, what you can do is you can go further. So this is pure cost of hedging, if you would want to call it that way. Now, always just a practical tip I would want to give out to the listeners if they are trying to hedge. Never try to hedge monthly. I will never recommend you to buy monthly put options. Like you go and buy June, and then after June you buy July, after July you buy August. If you do that, invariably you will pay 2 to 3% premium every month. You will end up paying 2 to 3% premium, and as a result, what will happen is you will basically have a very hedging cost of annually something like uh, 10 to 12% per annum.
Mm.
So that is going to be a very high cost if you are considering an annual hedging cost. If you do it monthly, so what I would always suggest is hedge for 6 months or hedge for the entire 1 year. 1 year will be a little illiquid, but you can always hedge for the 6-month time period. Your cost of hedging will be much more lower rather than doing a monthly hedge every time is what I would always recommend.
Okay. So you're saying if I take a longer duration put option, then I can reduce these costs.
Yes, because one of the factors that affects premium is something called volatility. So there is a lot of statistical calculation that goes behind it. So
Mm-hmm.
if I simply keep hedging every month, June and then July and then August and then September, the monthly annualized cost is definitely going to be 10 to 12%. So I wouldn't suggest doing that. Annually, you can hedge it at something like 6 to 7% per annum. Why you're seeing 6% for December is, just to clarify, the volatility in the market these days is very high.
Okay.
So there is something called implied volatility. So as the volatility becomes normal, historically you will see annual cost of hedging is something like 6-7%. That's your 1 year's peace of mind if you want to hedge, 6 to 7% per annum.
Okay. So this, because of current situations, it is more, it's 6% for even 6 months. That's what you're saying.
Exactly. Absolutely well said. Yeah.
Good. Nice. But I mean, I've seen you also, not just mean, of course, as a protection, hedging is a great idea. Using derivatives is a great idea. But I've seen you, heard you talk always about, trying and making money in derivatives also, right? So is there any chance that, I can, in current situations also, in so much volatility also, make profits in derivatives? Is that even possible, or is that too much to ask?
You can, but you'll have to always remember one thing, that you cannot benefit from anything without paying something. Now, either you pay an actual cost or you pay an opportunity cost.
Okay.
And I always personally believe that opportunity losses are better than actual losses. So if you opportunity losses, by that I mean you will have to give a part of your upside away, a part of your profits away, if you want to reduce your cost of hedging, if you want to.
Okay.
So I'll give you an example. Let me proceed and give you an example about that.
Yeah.
Now this is a historical monthly NIFTY returns, just for the user's understanding. This is from Capital Mind. I have taken it from Capital Mind website run by Deepak Shenoy. Now, if you see the monthly performance of Nifty, it's all over the place. You can't predict what will happen in a particular month. But you know that in a typical good year, if you're able to generate something like 10 to 12% Nifty returns, you should be very happy. So keeping that in mind, keeping that 10 to 12% from Nifty is a good return consistently. So what you can do is you can use derivatives to try and earn some consistent rate of return from your portfolio. The way you do it is you can use what is traditionally called as covered call options or a covered call strategy. So this is for those investors who are already holding portfolio. Currently Nifty is close to 10,140. You are bullish, you are expecting the price to go up, but you need to be rational. You can't say that from 10,000 market will go to 13,000. That is 30% upside, right?
Correct.
Are you looking for a 30% upside, or do you want a 12 to 14% consistent every year kind of profit, is what you have to ask yourself. And if you're happy with the 12 to 14% consistent profit every year, what you can do is every time market has run up, every time market has gone up a lot, like currently, you can sell a call option which is slightly what is called out of the money. So for those of you who are not aware of the basics of call and put, when you sell a call, you're giving away your profits above a certain level. So in my example, I have taken a 11,000 call. What it means is, if market goes up till 11,000, you will get all your profits. Above 11,000, you will not get profit. So if you're okay with that, which is what is called as opportunity loss in my books, you can earn 3.7%. You will receive 3.7% of your portfolio. So on a 1 crore portfolio, you will get 3,70,000 upfront. So when the market falls, you will have 3.7% less losses.
Okay.
You have
So
lesser losses.
if I've understood this right, in the earlier example, you said I can buy an insurance by paying a 6% premium.
Perfect.
So here you're saying that I should sell an insurance and get the premium.
Insurance which will be a loss for you when the market goes up and not when the market goes down. So
Okay.
here what you're saying is I am okay till 11,000 profit I am making. I'm very happy if market is at 11,000 and I'm able to make that profit. Above 11,000, you're giving away your gain basically. So that is your opportunity loss that you will incur to earn this 3.7% upfront.
Okay. So that's very interesting. So in case I can do this, so I protect my current profits at 10,000, right, and sell put option for buy a put option for 6% in premium, and then on the other side also buy this 11,000, sell this 11,000 call option. Then I get 3.7%. I spend 6%. So net I have only spent 2.3%.
Yeah, you can combine both of it also. So if you're sitting now and you're saying that I want to protect my downside,
Yes.
for which I have to pay something like 6%, but I want
Yeah.
to reduce that cost of hedging. I don't want to pay 6, I want to pay slightly lower.
Yeah.
Then you can sell a call together. So you can do this together. So you
Okay.
buy the put, which I showed you in the first screen.
Correct.
You also sell this call, you do it together, and
Okay.
your payoff will come something like this. I have put up two examples for your understanding. One is you buy a 9,500 put. So if you remember, below 9,500, your losses will be protected. Second is below 10,000, your losses will be protected. So I have put up both so that you can compare how it's working.
Okay.
So if you see 10,000 protection, the question you were asking me, Bhuvna,
Yeah.
you pay this cost, almost 6% per annum you are paying.
Yes.
You're okay not to make profit above 11,000. So you
Yeah.
receive this 3.7. So your net hedging cost is 2.3% only.
Okay. So I mean, I can protect my downside with a 2.3% cost,
Yeah.
but I should be okay with the capped upside.
Capped upside, because you are trying to get the best of both worlds. You're saying I want protection also, but I don't want to pay 6% also. Somewhere you will have to give something away, and that something away, if you see in this chart, is when market zooms up 11,500 it goes, or 12,000 it goes by December, by the way, your returns will not be 13 or 18. Your return will be capped at something like 6%, 7% kind of a thing.
Okay.
You should be happy with the limited upside. Your
Yeah.
cost of hedging can go down drastically.
Okay. Then I can do it for part of the portfolio also, and let the rest
Absolutely.
of the portfolio go up. Like, I mean, the idea is that I have an idea now. It's up to me to use it the way I want it, right? I mean, I can do a 50% hedge, 50% exposure, and all of that.
Yeah, and also more importantly, as I said, I think both of us being financial planners, both of us are rational enough to understand that idea is never to create the best performing portfolio of the world, right? The idea is to create a consistent returns over a period of time. So
Correct.
in 7-month time frame or 6.5-month time frame, if you're
Yeah.
getting something like 6%, it's not bad at all. I mean, that's a starting point you have to remember. So it's not like we are having any major losses.
Yeah. So there is one question that Naresh is asking from the previous slide. He's asking whether that data that you showed on Nifty performance, is it like that month opening and closing, or is it the highest and the lowest?
No, this is monthly, closing over opening for the month.
Okay, closing over opening for the month. Okay.
Absolutely. The
Okay.
source is capitalmind.in.
Okay. So Vishal is asking, does this work? Can you do this strategy even for small investors who have only invested 2 to 3 lakhs?
Will be difficult if you're only investing 2 to 3 lakhs. Will be very tricky, because
Okay.
one Nifty lot itself is 75.
Okay.
75 Nifty times 10,000. We are talking about 7.5, 8 lakh rupees exposure to one Nifty. So if you have a
Okay.
portfolio of 3 lakhs and you try to do anything with the Nifty, which is 8 lakhs, you are
Hmm.
either over hedging or exposing yourself to the remaining 5 lakh risk. So it's not going to be easy.
Okay. So you're saying the portfolio size should at least be 10 lakhs to attempt something like this.
Absolutely. Or you are looking to invest 10 lakhs or already invested 10 lakhs.
Okay. So Sandeep is asking, but if you're a long-term bullish on Nifty, it's not suggested to do this strategy. He says net you will be in loss if you get called out, meaning if you sell covered calls as well as buy protective put. Is that true?
So the question is, what do you mean by long-term bullish? Are you expecting 25% CAGR in Nifty over the next 10 years? I am not. So I'm very happy at 12 to 13% CAGR over the next 15 years. So long-term bullish definition is very important. So if you're saying I expect market to go up at least 20% every year, then don't do covered call. Don't try to protect, or don't try to give away your upside above 11,000. If you ask me, I am very happy to give away my upside beyond 8% every 6 months, because 8% every 6 months is 16% every year. So for me, I am trying to earn consistent rate of return. I'm not trying to beat the market.
Well, consistently 12-13% not going to hurt at all, right? Over a very long.
Obviously, because if you're only going to invest in Nifty, we all know what will happen. There will be 1 year where we wiped out. So you're not going to be like a champion, right? You will keep buying, and at exactly the right time, you will sell also. Then nobody should have had a loss in March. Why would everybody bleed in March?
Yeah. I mean, so Sandeep, I hope that answered your question. Long-term bullish on Nifty. I think everybody is long-term bullish on Nifty. But the point is the short-term uncertainty is hurting us. So can we protect the short-term uncertainty in some way is the question that we were trying to answer. Of course, if you're long-term bullish on Nifty, don't waste money doing all of this.
Yeah,
So
just wait and let the India story or whatever story run its course.
Run its course, correct. Great, superb. So there's one more question here. What happens if my stocks are not on Nifty? So if I have non-Nifty stocks, can this be done on specific?
Will be difficult. So if it is a stock which has options, you can still try and do it. But the problem is stock options are available only up to 3 months in India. We don't get 6 months and 12 months like Nifty. Second problem is most of the stock options are very illiquid beyond the first month. So whatever combinations you will try to do in stock, practically you can only do it for a month, the first month. And in my experience, it doesn't really work that beautifully like it works in the case of Nifty. You can try, but stock will be less effective.
Less effective. Okay. But if you have a portfolio that's closely like a large cap portfolio that clearly mirrors the Nifty, you just stick with Nifty instead of trying stocks and all, right?
Absolutely. So if you have a portfolio which is like a mutual fund portfolio that you're holding, you can still do it. You don't need to have a stock portfolio. But if you, let's say, have 8 lakh rupees of Maruti, for example, then Maruti options are available, but only up to 1 month is liquid. You will not get liquidity beyond that. And first month only trying to hedge is not a very logical thing to do, because your cost of hedging will be 12 to 14% per annum for a stock. You will pretty much give away all your upside.
Interesting. So you were mentioning mutual funds, right? So if somebody's got a mutual fund portfolio also, covering against Nifty is a good idea. Is that
if it's a large cap or a focused fund that these days are coming out, where the beta of the portfolio is close to, let's say, 1 or in the range of 0.9 to 1.1, then you know that the performance of the portfolio and performance of Nifty will be mirrored. But if you're trying to hedge your small cap portfolio or a mid cap portfolio, it is obviously going to be a challenge.
Why are you doing this to the screen now?
I'm not doing it. Somebody else is doing it.
Really? How can somebody else? Okay.
So it was enabled. The concept of annotation was enabled. So somebody is just trying to be creative.
Oh, good. Okay. So guys, please don't be creative. Take your hands off the screen on things like this. There are a couple of more questions. Okay, Amrita is asking 12 to 13%. Why people should not invest in MFs than staying in market? I'm not very sure what she is asking. If 12 to 13% is the rate of return expected, why should people invest in mutual funds? I don't know. Okay, maybe we'll come back to this question in just a little while. Guys, I mean, just to tell people here, we're not giving specific views. So there are questions on what's your view on the 10,300 call and this. So that is something that we will stay away. Right now, let's discuss more, situations. We will see what really happens, what can be best to do. So you mentioned one case where if I'm already invested, what I can do, right? I can protect my losses by buying some put options. So with just 6% cost, I can ensure that if there's a downside of 20-30%, I am protected. And I can also reduce this cost a little by selling a call also, right? So that's like an amazing strategy. For something like a 2.5-3%, I can buy a certain amount of peace of mind.
Protection.
Protection and a 12-13% expected return, which I think is very fair. That is in real terms having the cake. And okay, so you're not having the cake really, but you're not destroying the cake, and you're eating it too. So I mean, that's great. What if somebody is is waiting to invest? what if somebody is waiting to invest, right? So they have cash, they've been waiting for some reason. They were Dirgdarshis, and they knew that this market fall is going to happen. And then what they did is they didn't invest in the downside. When 7,800 happened, they didn't really invest. So now they're still sitting on cash. They've missed the bus waiting for to catch the bottom. Now, what is the strategy? If I have cash, I'm looking at investing. What should I do? Should I invest now? Should I wait? Should I hedge and invest? What is a good strategy for me?
Right. So this is a very tricky one, because now it depends a lot on what is your view going forward. Because if you're fully invested and if you don't have any money, then the only thing you're trying to do is protecting your portfolio. But if you have money and you're thinking when to invest, a lot of options will open up for you. So obviously this is one question that we discussed as a precursor. So I've just put across certain thoughts together, which I will like to share in the presentation, and then we can again take questions if you have.
Okay. There
Now,
are some questions. I'm just keeping them on the sideline. Let's have this discussion. I mean, we'll take those questions obviously, but let Harish finish with what he's got to say.
sure. And before I come to that particular question you asked me, I would just like to add one aspect which is very pertinent to what happened in June. Starting 1st June, for the benefit of many of you, and most of you also know about derivatives very well in the participant list, there is a concept called as margins, which has come down drastically from June 1st for what is called as spread trades. Spread means range. So whenever you want to do a trade which is range bound, you want to kind of play a range, the margins have come down drastically. So I'll give you an example. Suppose you're sitting on an equity portfolio, which is pretty much the extension of my earlier point, and you're long-term bullish. As one of the participants asked, what if I'm long-term bullish? I'm expecting big rally. Fair enough. But you're not expecting a big rally every month. You're not saying that every month it will go up by 3-4% consistently. That's not going to happen. Especially in a situation like now, when from 9,000 till 10,200, we had a huge rally. Now, I don't think anybody is expecting another 1,000-point rally quickly. So for scenarios specifically like this, what I would suggest to the portfolio creators is you can do what is called as a non-bullish call spread. What it essentially means is you are taking a view that market will not go further beyond a certain point. So 10,300 is the point I have chosen. So you're saying it may not cross 10,300 and you're okay to give a little bit of returns beyond that. It's like a covered call thing. But if the market runs beyond 10,500, I will get that profit. So it's a small range you are giving away. You're saying, you know what, I don't want the profit between 10,300 to 10,500. If market falls, I earn this 0.75% for the remaining 20 days to expiry. We have 20 days left. So if the market falls, you earn 0.75%. If market goes up till 10,300, you still earn your 0.75. Market goes to 11,000, etc., you will still make money. In a small range, you'll have a loss. So you can kind of customize your view-based strategy also. And I have done this for a lot of my clients and in my portfolio. It is fairly easy to logically earn 0.5 to 1% per month without giving all your upside away. So that is your theme. You can eat the cake, you can eat the upside, but also try to earn something like 0.5 to 0.8% per month. You can do that by doing what is called as spreads. Why I'm saying it? Because the margins have come down drastically in the case of spreads from June 1st. So I just wanted to make a point on that.
Okay. No, so so I shouldn't invest. I should just be doing this particular.
No, this is for those who are already invested. So you're already holding, and you're basically saying that, you know what, I am holding my portfolio for long term. I don't want to give away my upside. I'm okay if the market falls, I will hold on for long term. But while I'm waiting, can we earn some extra rental income on it? So this is like your dividend yield, as you call it in stocks, right? So you can earn this 0.75% every month as so-called rental income, and keep your portfolio long-term intact. There is no loss as such you will have in the long run. But remember, it's not a hedge. If the market falls, you'll have a loss, but you will able to earn 0.5, 0.6, 0.5, 0.6 every month. So imagine for a year, you can still make something like 7-8% per annum over and above your portfolio. This is what is called alpha.
No, so we were talking about people who are looking at entering the market now.
Yeah, so that is my next point I would like to discuss. A very
Okay.
pertinent question. You use that phrase which is in the market today, miss the bus kind of a thing.
Yeah.
Now in my example, I'm assuming you have 8 lakh rupees. Just an example. Why 8 lakhs? Because that is typically your one lot of Nifty.
Okay.
So you may have 1 crore, you may have 20 crore, but if you have only 1 lakh, then this is a problem. It is not going to work. So
Okay.
minimum 8 lakhs above, you can do something like this.
Okay.
So Nifty is at 10,140. You have 8 lakh rupees. You're sitting on cash and you're wondering what to do. Option number one, what you can do is you can simply invest in Nifty today. That's one option you have. Go out there, purchase the market, forget about it. That is one option you have, as you can imagine. What will happen? I have taken levels for December. What happens if Nifty goes to 8,000, 8,500, 9,000, 9,500, different levels of Nifty? This is your portfolio value of 8 lakhs in December end. So you can see a range from 21% loss to a 18% profit by December.
Correct.
This is
So
classic.
go
Let's
and
buy today. Yeah.
okay, if I go and buy today, correct.
Because people have missed the rally. A lot of people are like, what happens from 8,000 to 10,000? I have not invested. I will regret more if it goes to 12,000 also.
Right.
So you can just go and invest. Especially you will do this if you are very bullish from today. If you are very confident of 11,500, 12,000 by December, I would straight away recommend go and buy it. Because if you are so confident that 20% upside is going to happen, please go and invest. 20% for 6 months is mind blowing. Absolutely brilliant.
Absolutely.
Second option for people who are not so bullish is they will put this money in debt funds. Correct? I'm sure many of your investors are also investing in arbitrage funds or ultra short.
Correct.
I'm expecting, and again we can debate on the returns. I'm expecting 3% for roughly 7 months, 6.5, 7 months. 3%. So you can say no, 3 nahi milega, 2.5% milega. We can debate on that. For calculation sake, I'm assuming 3%.
Okay.
So what happens? You invest 8 lakhs, you earn 3% wherever be the market. It doesn't matter, right? Because you're investing in a debt fund.
Yeah.
This is your payoff, correct? Stay in cash. Wherever the market goes, you have 8 lakh 24.
Absolutely correct. So this is straightforward. Okay.
Now, the beauty in this is if you are very bearish today, you should do this.
Okay.
If you are supremely confident that market is going back to the previous lows of March, then you should not invest today, right? Then you're waiting for that golden opportunity of below 8,000 Nifty.
Correct.
And by then you will have 8 lakh 24 lying with you. And Nifty is at 8,000. Wow, that is like Diwali, right? That is when you go bonkers and buy Nifty at that point.
Correct. Correct.
Now, people I know in my circle are neither extremely confident about market going up at this point, neither are they sure whether market will go down to 8,000 or not. So that's the confusing kind of a scenario that I am trying to address in the next scenario. Like I repeat, if you're very confident market will go up, please go and buy Nifty today. Nifty, index fund, large cap fund, multi cap fund, whatever. If you're supremely confident market is going to go down to 8,000, please stay in cash. Don't touch equity now.
That we don't know now. So that's the problem, right?
So that is why I thought, why not create a win-win?
Yeah. Yeah.
I mean, if we had so much confidence, then we'll be God, right? We'll be like, wow.
I know. So that's all in the imaginary situations. Now, tell me reality.
So what's the realistic situation? I don't know where the market will go. It may go up, it may go down. So if it goes down, I don't want to make the loss of equity. I don't want to have this 16%, 21% loss. Correct?
Yes, I don't want to.
If it goes up after I invest in cash, if I invest in debt fund, and suppose market goes up by 10%, you will regret, right? Arey, humko to 3% mila. Market to 10% upar chala gaya. We can combine both of it by doing a very simple strategy for December. You can buy a 10,500 call. So first of all, invest 8 lakh in the debt fund. So put the money in the debt fund.
Okay.
Earn 3%. For sure, you will get 3% on that.
Okay.
Now buy a 10,500 call. What happens when you buy a call is you have a right about 10,500 as your profit. If the market goes above 10,500, you will make profit. All the upside is yours about 10,500.
Correct. Okay.
But you have to pay a premium. It is a option you are buying. So the premium as of yesterday is 600 rupees.
Okay.
Per Nifty. Per Nifty 600 rupees you have to pay.
Okay.
Now understand, 10,500, if you pay 600, you have no profit till 11,100 now.
Correct.
So you don't want that. You don't want so much of a bad payoff. So
Mm.
what you do is, second thing,
Mm.
you sell a 11,000 call. You're like, okay, I am okay if the price goes to 11,000, I will get that upside. So you're receiving some premium. You're subsidizing your cost of buying the call option here, basically.
Okay.
It's a
Okay.
little complicated. And you also sell a put on the lower side.
Okay. So selling.
Basically what it means is if the market crashes down a lot, you're happy to buy Nifty at that point. You're very happy to buy Nifty at 9,000 or 8,500. You're very happy to buy Nifty at that point. That's the thought process.
Because I anyway have the money in debt funds, no, so I can go and buy.
You have money. You can go and buy Nifty when the market goes to 8,000 or 9,000. So you sell a 9,500 put. The benefit of doing these two sell is that you net receive premium. You earn a net premium of 215 bucks. So you're not now net paying, you're net receiving.
Okay. So this happens. So if markets fall, then I still have money in debt funds,
Yes.
so which I can use to go and buy. And
Yes.
I've made a 250 rupees profit on these premiums. And if the markets go up, then my 10,500 call will get me the upside, is it?
Yeah. From 10,500, you will get the upside till 11,000 only.
Okay.
So if the market goes to 12,000, you will not get the 12 to 11 upside. So the point that I'm trying to make is you're not very sure whether market will go to 12,000 or not, right? So you want to protect your downside and you also want to participate in the upside. I'll show you how it will now play out in the next 6 months, assuming different market levels.
Okay. Sure.
So different market levels again, 8,000 to 12,000 scenarios. I don't know where market will go. You don't know where market will go. Even market doesn't know where market will go.
Correct.
But wherever it goes, you have your 8,24,000 from your mutual fund.
Correct. From debt.
From the debt or arbitrage, whatever you invested into.
Yeah.
3% you will get on 8 lakh.
Correct.
You also receive your premium. Now what is 16,125? 215 times 75. One lot of Nifty 75.
Correct. Okay.
You receive this. You earn this. 16,000 is yours.
Okay.
Now, the options that you have traded will create payoffs now. So the call which you bought will give you profit about 10,500. This is the profit you will make. About 10,500 only. Not when the market goes down. You will have a profit. This is all your profits, by the way. You will enjoy the profits.
Correct.
But you have sold a call also.
Yes.
So beyond 11,000, you have to give away some of your profit. As I said, opportunity loss will be there.
Yeah.
And below 9,500, you will have a loss on the put option also. So below 9,500, you'll have a loss in the put option also. So both sides, there'll be a little bit of loss. In between, there'll be profit. So what will be the net payoff? What will happen as a net result is this. Now, I would request you to compare this payoff, what you're getting in this strategy, to both of the scenarios. Suppose you invested everything today in the market. You could have seen a 16 to 20% downfall in your portfolio.
Yeah.
But now your downfall is only 4 to 9%. I think 4 to 9% is more tolerable than 20% loss, right? Also, don't forget you have money now. You can go and buy Nifty at that point.
Correct. If it
Don't forget the fact that you have the 7,27,000 rupees money left with you.
Yeah. Yeah.
Go and buy Nifty, and on that day, go and buy Nifty. What is the probability that from 8,000 it will go to 6,000? Maybe unlikely. So you can enter at that point.
Yeah.
Suppose you had sat in cash, and upside if you see is only 3% in cash. Here you get 5% and 10% upside also. So you get profit up to 10%, limited loss up to 9%. So you are able to kind of get the best of both the sides. This is something which you can do if you have not invested till now and you're trying to enter today.
Okay. Oh, this is interesting. So I can keep the cash and buy when markets fall, but my fall has been only 9%.
Yeah, which is much better than 21%, right?
Just going and putting the money in and seeing the portfolio bleed. Yeah, that's not a great idea. But on the upside, then what could have potentially been 946 would be 877. So,
yeah. And that is if the market is up by 20%. So as I said earlier, if you're sure that market will go up by 20%, please don't do all this nonsense. Just go and buy market.
Just go and buy market.
I mean, who's confident? I mean, anybody in the room who can say it will go up by 20%.
Yeah, nobody can be very sure. Yeah.
So if
This
you take
point,
more realistic 11,500 levels, if you take more realistic levels of 11,000 or 11,500,
yeah,
then you're actually better off. If you see at 11,000 level, you're better off.
yeah,
At 10,500, you're better off. So you can kind of create something like that. And this is just one example. You can do a lot more if you want to go in.
yeah. No, this is interesting. Just for a little insight into what possibilities are there instead of just being a sitting duck and suffering that loss. There are a lot of questions that we might have to just take now.
Sure.
So I mean, I'll just go as we go by. Does this work? Even okay, we saw this. What's your view on 10,000? How can we do a covered call if 50% of the stocks are not in NIFTY? Yeah, we saw that. How do margin costs factor in for the overall call? How much do they impact the overall returns? So that's a question.
Should I take that?
Yeah, if you can.
So margins are something that you have to block if you write options, if you sell options. Whether it is selling call, whether it is selling put, you have to use your margin deployment. But the benefit of that, the advantage is that your portfolio, your ultra short debt fund or your arbitrage fund or your liquid fund can be given as margin. You don't have to block extra money for that.
Okay.
So margins can be taken care by your portfolio, provided it is in demat form. Many of us don't have mutual fund in demat, so that will be a problem.
Okay.
But otherwise, margin can be taken care of.
Okay. Okay, so Pooja is asking, so if you're doing a covered call, will it be beneficial to sell every month than 6 monthly? If you're doing a covered call?
So if the objective is to earn some kind of a rental income, if the idea is to scalp some 0.5%, 1% kind of a profit on a consistent basis, then doing it monthly by selling a 3% or a 5% out of the money call will be a beneficial strategy.
Okay. Yeah, I mean, yeah, that's pretty clear. So Rajpal is asking, I mean, I think you've answered that with this example, but he's still asking, we could just see if there's any part of it that's not answered. The market is flattish, let's say at Nifty being at 10,200 levels itself, right? Then what happens? Will I be better off or worse off? He's saying hedging will not even cover the cost of hedging, doing the strategy. So will it make sense?
So if I understand your question, if you have just invested today, then this strategy will be better off, because if you see if the market is flattish, then this strategy earns you more money. Okay. But if you've already invested and you have hedged it by buying a put option and market did not fall, that means your view went wrong. You hedged because you thought market will fall. So if you did not have that fall coming, then obviously your loss will be there in that premium. You can subsidize the premium, as I told you, by selling a call against it.
Okay, that makes sense. Palash, I think that's answered. MF units can be used to get margins.
If in demat.
So saying existing capital market, is it safer than derivatives? So this is a question, no, right? So on the safety of derivatives, no, Harish, just stay back on that earlier slide. I think there are some more questions on it.
Sorry.
Yeah, clarifications on slide 9. This 9% includes the debt of 3.5%. Have you include that 9% returns? Is the 3% included? The 9% loss that we talked about?
Yes,
right?
Because this 7,27,000 is the total of 8,24,000, which is 8 lakh plus 3%.
Yeah.
Plus 16,000 minus 1,12,000. So it includes the 3 from the debt.
Correct. Absolutely. I hope that answers your question, Naresh. Liquid funds can only provide, but liquid funds can only provide 50% margin. Is that true? No, right? So like
no. There are a lot of, so the fact of the matter is that brokers, when they provide liquid funds to the exchange treats liquid fund as cash, not the collateral form. So there are brokers in the market. I am not naming them, but there are many, many brokers in the market who provides liquid fund as cash. I do it every day.
Okay. So 50% is the limit on that. Okay, what? Okay, good. There were some questions also on arbitrage funds. So why are arbitrage funds not giving us returns? I mean, aren't they supposed to be the safest form of derivatives?
So it's a very good question, Bhuvna, because in the last week or so, arbitrage funds have given negative returns. What you have to understand is arbitrage is conceptually risk-free, but the way these funds are created, I'm sure many of them in the batch would know that in the participant list. You buy the stock and you sell the corresponding futures against it.
Correct.
So on a normal day, in a normal market condition, futures trades at higher than spot. There is something called cost of carry. So if spot is 100 and futures is 101,
okay,
you can earn that 1 rupee as risk-free profit.
Okay. Yeah.
However, what we are seeing is abnormal days also. March was an abnormal time, second half of March.
Yeah.
Last week was abnormal, where what happened was futures traded at a discount to spot. So if spot is 100, futures is 99. So if you buy spot, sell futures, you have a loss.
Correct.
You essentially will not have any arbitrage opportunity.
Okay.
Plus, the second thing that many investors in arbitrage fund don't realize is the mark-to-market risk. So when you do an arbitrage, the spot also moves every day, the futures also moves every day, but due to irregular market movement, due to short-term volatility, the spot and the futures may not offset each other every day. So there could be fluctuations that can happen on a daily basis. So what I always recommend to my investors is, do not look at arbitrage fund as a substitute to liquid or an overnight. If you're investing only up to 1 month or 2 months, please don't consider arbitrage as risk-free. But if you're investing for 6 months, 8 months, 10 months, 12 months, you will not see abnormal market conditions going on for so long. So the returns will come back to normalcy beyond few months.
Okay, so you're saying if I'm holding it and have a time frame of about a year or so, I hold on to the arbitrage funds.
At least 3 to 4 months, I would say.
Okay.
Not for a week, not for a month.
Okay. So I mean, I hope that answered those questions on arbitrage. So I mean, this has been nagging my head a little while. So I mean, I see that a lot of people here in our audience are they've been in derivatives quite a bit. They're asking very evolved questions. I'm not.
I know. There are a lot of stalwarts in this batch, and I'm very happy they have joined in. They're all traders in many cases, so obviously we'll have to take some of those questions offline.
Okay. Yeah. So you can take those questions offline. I have just one question. We are at 7:24. We just have another 5-10 minutes to go. I mean, I'm a normal mutual fund, long-term stock investor. I've not done too much of derivatives except for a little bit of here and there, whatever you've been teaching us. But I'm a long-term bull. I'm optimistic about India's growth and all of that stuff. I keep hearing from big people like the Buffetts of the world who say derivatives are weapons of mass destruction and don't go that way. You can make losses and losses can be really big. I mean, it's a little scary, although what you're saying is I mean, it's making sense logically as I hear you, but that fear of it not being something that's easy, simple, transparent, that's gnawing at the back of our mind, right? So what do you have to say? You've spent your lifetime on derivatives, so when you hear something like that.
Yeah, so Warren Buffett has obviously been quoted multiple times. I think he said it once, but the echo effect has been probably a million times since then. I always say this, he said it in an annual general meeting of Berkshire Hathaway, in his shareholders meeting. Yeah. He was putting it in the context of credit default swap before 2008 crisis. So he was not really talking about every derivative in general. That is my first point. Okay. Second point about a derivative being risky is, yes, it is risky if you don't use it well. Okay. The counter question which I normally put for an argument like that is, do you think equity is risky for that matter? You know, investing in equity, is it risky or not?
Of course.
The answer is risky, right? I mean, if I have 1 crore, I will never go and say, you know what, just go and randomly buy some stocks. But if I go to an equity fund manager, any equity fund manager who's managing equity portfolio for years now, and if you tell him, you know what, equity is risky, don't invest in equity, he will laugh it off. Because the thing that you're understanding, or you should understand, is the fact that knowledge is the biggest hedge against any mishaps. So Warren Buffett also uses derivatives. I also use derivatives. Should everybody use derivatives? No, they should not. So if you know the product, if you know how to use it, it can really be value adding. But if you don't know the basics and if you're not aware of how it is going to work, I would obviously say it is risky. And for that matter, anything is risky. Investing in a credit risk fund is also risky.
Of course, that we saw.
That we saw. So risk is everywhere. What is
Yeah.
the biggest hedge against risk? Knowledge. So the
Yeah.
more you know,
Hmm.
you will be able to obviously use derivatives very well.
Excellent. I think that makes a lot of sense. Karthik has one question. He's desperate that I shouldn't close this chat without asking this question. So he says, what is the exit strategy for December 2020? So you gave us this strategy for December 2020, right? What we see on the screen right now. So
Yeah.
when do we exit exactly? So what's the view?
So in this strategy, there is no exit. I am a long-term investor in this strategy. So I am somebody who has 8 lakh rupees. This is the thought process behind this particular slide. I have 8 lakh rupees. I want to invest for 10 years, but I don't know whether to invest now or wait for 3 more months or 6 more months.
Okay.
So there is no exit strategy. You will only end up buying Nifty at the end of December as your best case. And then you hold it for as many years as you want to. This is not a trading strategy. None of the things I spoke about today is a short-term trading strategy for a trader. All of these are portfolio strategies for long term.
Okay. So there. So these options that we buy, call all of them. You hold it till December, right? Just
Everything will go till December. Wait
Yeah.
for what happens in December. If Nifty is below 8,500, you buy Nifty.
Very good. Okay.
Market is at 12,000. You continue doing this for the next 6 months again. So
Okay.
every 6 months, if you do this, you can earn 8 to 10% every 6 months. That's 15-16% per annum. I mean, Bhuvna, I'm very happy if I can get 16% consistent.
Obviously, and not take risk on the keep
Equity.
the gap. Yeah. Okay. Yeah. I mean that sounds like a good deal. Yeah. So there is some more question. What fixed rate of return will you be able to provide? Assuming I have a 1 crore capital using all the derivatives, will it be more than FD returns and how much? So that's a question, very straight question on what kind of returns can I expect from the
So
strategy.
I cannot generalize and say what anybody can get, but in my experience over the last many years, we have been able to generate pretty consistently more than 12% every year using derivatives in a very safe manner. Pretty consistently 12%. We have investors who gets from us 12% per annum, absolutely safe.
Okay, absolutely safe. Did you say safe?
Safe, yes, subject to knowledge risk, market risk, things going bad risk, and all that.
Okay.
But
Naresh,
not equity risk, not about Nifty. That's what I mean by safe, not connected to Nifty.
okay. So you're saying the underlying is if it's Nifty, then the risk of that is on the client, and on the derivatives, you're saying there are no risks.
Yeah, I mean, we can create portfolios like that, which we do for ourselves and few of our clients. But again, not everybody will be able to do it as a disclaimer.
Okay, fair enough. Naresh has a question. If you sold a call or put, are you supposed to buy again? And likewise for buy, do we need to sell in December for closing position?
No,
So
just let it go into expiry.
let's go into expiry. Let it just go into expiry. Okay, great.
Nifty options are not gross settled, so there is no settlement problem. Just let it go into expiry.
Oh, okay, good. So if you were told to buy 4 to 5 companies in different sectors and you can't sell those companies for the next 10 years, which sectors would he's asking you sector specific questions. You want to take it?
No, I'm sorry. I'll have to skip that.
Okay. So, sorry, Sandeep he's a derivative expert. Ask him that, not sector specific.
No, I think Sandeep knows where he can reach me anyways.
Yeah, so he knows. Very good. Okay. What happens if Nifty comes to 8,500 before December 20? Can we jump back into MF in between? Yeah,
No,
so.
in this strategy, I would just recommend you to just keep waiting. Just go till expiry.
Yeah, but see, he's saying 8,500. If Nifty comes back, you can always square off your mutual funds or whatever debt you have and then go and invest in Nifty, right?
Yes, but the premiums that I have calculated in this slide will not be the same because there is something called as time value of money that will come up. So you can easily go from debt to Nifty, but what I'm saying is the payoff will not be exactly the same.
Okay. That's all right. But the underlying, whether it lies in a debt mutual fund or an equity mutual fund, how does that matter, right? I mean, I see that the markets have fallen and I just want to move from the debt mutual funds that I'm holding into equity mutual funds. That's fine, right?
That is fine. But then from that point onwards, suppose you did this in October, for example.
Okay.
So what happens between October to December in Nifty will change your final payoff from whatever I have shown in the slide.
Yeah.
So you may suddenly go lower to 6,000 also, right? from 8,000.
Yeah.
So that is not incorporated. I have not done any dynamic shifting before expiry in this slide.
Okay. Sandeep says, yeah, he's an equity expert too. He's just very modest, and so he's just doing a little bit of yay. Okay.
Yeah.
That's he's asked. So there are questions on market view by December 2020. This is going to be the last question that we take. You can leave this on that note. What do you think? What is your view on markets December 2020?
I wish I knew, Bhuvna, to be honest. In the short run, I think markets are probably overheated. But then in 17 years, what I have realized is market can surprise you, market can shock you. The moment you realize that I think I have understood how Nifty will perform, it will give a slap on your face and do something else. So I have given up long back, and I have realized that I am not very good at predicting where the market will go.
That's the truth, right? I mean, I'm glad to hear that from somebody. Can you share your details, Harish, on the Okay, so for those of you, I think this was, we've tried to answer most questions here, most relevant questions of whatever conversations we've had. And I think this was brilliant, Harish. It just gave us a little insight into how derivatives can be used as a hedge, as a possible income generation strategy, and what you should do, what you shouldn't, more importantly, what you shouldn't do about derivatives. So people have your contact details here. Harish is amazing, as you've already seen. He runs a company called Hedging Capital, and they do some incredible work on clients' derivative portfolios. Feel free to reach out to him. And in case you have a core portfolio that needs a good look, you need a financial plan done, reach out to me. My name is Bhuvna, and I've shared my credentials with you. You know where to find me, right? So thank you very much, Harish, and such a pleasure talking to you. And thank you so much, all of you, for being
Thank you, Bhuvna. Thank you for inviting me here.
Yeah.
And all the best for your future sessions.
Thank you very much. And you guys, please stay clued in. We have more sessions coming next week, and we'll stay in touch. Thank you so much. Have a great weekend, all of you. Bye-bye.
Thank you.